Corporate finance practice problem using Excel. Common stock value calculation considering the assumption of stable growth. Get ready, it's time to take your chance with corporate finance. Here we are in Excel. If you have access to Excel and would like to follow along, note that we are in the Practice 1 tab. There's going to be 2 practice tabs here that we will be working through. We also have 2 example tabs. The example tabs, in essence, being an answer key. We're going to have the information on the left-hand side. Use that to populate the blue area on the right-hand side. We're looking into an estimate of what we would think the value of the stock would be, or the price would be, possibly the price that we would consider purchasing stock for, and we're going to make some assumptions in order to get to that valuation. Note that the stocks can be a little bit more complex than some other types of calculations when we're thinking about the rate of return type of concepts and the price of them, due to the fact that we have multiple components that would be included that we're considering when we consider the value. One would be the rate of return, that would be the most common or the most direct, that would be the dividend component. And the other would be basically the growth, how much the stocks are increasing in value. Because if they increase in value, then of course we could sell the stocks on the market if we're talking about publicly traded stocks and receive a return in that fashion as well. So typically you would think that, you'd have increases in earnings that would basically be taking place, the value of the stock then increasing, and some of that value then, if paid out in the form of dividends, would be paid out in the form of dividends. So let's just do a quick calculation here. We're going to say the annual cash dividend, we're going to say, is $5.80. We expect that to happen at the end of the year. We have the stable growth. We're going to assume that there is stable growth in the stock of the 8%. So we have the cash dividend. That's going to be something coming directly to us, of course, of direct return. And then the growth also is kind of a return due to the fact that the value of the stocks that we own now have increased. And if we wanted to realize that, then we could sell the stocks and realize that growth. So the required rate of return for the common stockholders is 16%. So this is something we're assuming on the market. The market is demanding, in essence, a 16% return. How could we calculate what we would consider the value of this stock to be? So let's pick up the dividends. We have the dividends here, which are going to be 5.8, we assume, at the end of the year. The required rate of return, and let's make this some decimals, add some pennies, numbers group, add a couple pennies. We're going to say the required rate of return is going to be this 16%, making that a percent, numbers, percentifying it. And there's also going to be growth. So the growth we're going to basically remove from the rate of return to then calculate the price based on the annual cash dividends. Let's see what that looks like. We're going to say this is going to be equal to the 8%. That's going to be the growth rate. And we're going to say numbers, percentify, font group, underline. I'm going to subtract those two out. So the 16% rate of return is being taken care of, in essence, 8% of it by simply the growth in the stocks, in the growth rate that's taking place. That leaves then, numbers group, percentifying this, 8% remaining. And I'm going to underline this, font group and underline. So then the price based on that 8% after the gross, we're going to take then the 5.8 times, divided by the 8%, and we're going to get the 73, adding some decimals, numbers, adding a couple pennies, we're looking at 72.5. So we're estimating the value then, price, 72.5. Let's do that again. Let's go to the practice problem 2, and we'll do a couple more. We'll do a few different alternatives so you can see how the relationships will change now that we've added basically another dynamic here, that not simply being the payment that we'll get directly, the dividend, but also the rate of growth. So let's do the same calculation here. We're going to say the dividend is going to be $8.10. The stable rate of growth we're assuming is the 6%, and the required rate of return is going to be 18. What do we think the price would be then? We're going to say, or the value of the price. We're going to say, all right, the dividend is going to be $8.10. And we would typically compare that then to the required rate of return, but that's not the only thing we're getting here. We're getting the value of the stock, which is increasing as well. So I'm going to go to the numbers group, add some decimals. We've got the required rate of return, which we're saying is that 18%. So 18. And we're going to go to the numbers group, percentify that. And then we're going to say that we have then the growth rate, 6%, numbers group, percentify, font, underline. That means that we have then remaining percent, the 18 minus the 6. In the numbers group, percentifying, that's the wrong percentified cell. Hold on, percentify this cell, and don't percentify that cell. And then I'm going to underline this, font and underline. That leaves us with 12% that is remaining that I'm going to compare to the dividend. So the dividend is going to be the 810 divided by the 12%, adding some pennies there. We get to the 67.50. So we're estimating this time 67.50. Let's do it a couple more times. Now there's going to be a change here. So we went from 810 to 710. And then we have the growth is now 8% on the growth. Required rate of return at 23. Let's do the same kind of calculation. We're assuming the dividend is going to be equal to the 720. Adding some pennies. Numbers group, adding some pennies. The rate of return now being equal to the 23%. Then we're going to say numbers add, or make it 8%, minus the 8%, the growth rate. Then numbers, percent, font, underline. Subtracting that out, then we have then the 23 minus the 8%. Numbers group, percent. We then have 15% remaining, font, underline. So now we're going to compare the dividend to that 15%. We're going to say this is going to be this 720 divided by the 15 rate of return that we need after considering the growth rate. And that's going to be the $48, and adding some pennies, we're looking 48 even on that one. Let's do it again. We're going to say now there's a change. We got the 710 at the dividend. The stable growth is now 9%. Required rate of return is now 20. So that's going to be our new comparison. Same kind of calculation. We're going to say outer calculation. This will be the return or the dividend, which is going to be adding some decimals, 720. The required rate of return being the 20%, making that a percent number group, percentifying, minus the 9% in the numbers group, percentify, font group, underline. Subtracting those out, we're taking the 20 minus the 9. And then in the numbers group, percentifying that, font group, underline, we have 11% remaining after we consider the stable growth. Comparing that to the dividend, the 720 divided by the 11% gives us then, adding decimals, the 65.45. Let's do it one more time. Now the assumption is the dividend is $8.80, stable growth 8%, required rate of return 20% here. So we're going to say, all right, now the dividend is going to be 8.8. We've got and let's add some decimals, numbers, decimals. And then the required rate of return this time is 20%. Going to make that a percent, numbers group, percentifying it. Subtracting out then the 8% on the stable growth, making that a percent, font group, and underline. Subtracting this out, that's going to be the 20 minus the 8. Then we're going to go ahead and make that a percent, numbers group, percent, font group, underline. Then taking the 880 divided by the 12%, we get the 73, adding a few decimals there, we got the 73.33.